So welcome back, ladies and gentlemen. Those of you who were here this morning, I think we enjoyed a very, very interesting and very practical session on how to manage an SEC visit. And thanks again to the panelists that attended, as well as my colleagues from New York and San Francisco who made the trip to make that session so successful. My name's Stephen Burke. I'm the Managing Director of Cordium in EMEA, and I'm very pleased to welcome you to this afternoon to our third regulatory forum. We have a very, very packed schedule. I'm starting the introduction when many of your colleagues are still waiting to come in. I think the lunch must have been rather more spectacular than they were expecting. We thank Bloomberg very much for these fantastic facilities that they make available to us for our regulatory forum. And I also thank the panelists that we've got lined up this afternoon. Many of them are sitting on the front row already poised, who will give you the benefit of their experience, as well as you in the room, who I hope will contribute as actively as the audience this morning in terms of asking your questions with the iPad devices that we've given you. Over the past 3 years, we've been working to build and develop Cordium. It really began to come together in May when we rebranded our US and UK businesses to one name, since we needed to develop a single identity. And during the last 3 months, we've been rather busy adding accounting, tax, and recently, very recently, an office in Malta. And I'm very pleased to say that de.Domenico, the CEO of our Malta office, will be joining us on the AIFMD panel slightly later. We've also been building a presence in Hong Kong, and that's still very much under development, and we've got a small team now who are located in Hong Kong doing SFC compliance work. All of these things we're doing not because we've got nothing else to do, the compliance agenda is busy enough. We're doing them because our clients want a global provider of services covering the locations where they're working and providing the services that they need to run their businesses effectively. And we'll continue to add to the service provision as we get feedback from you as to what we ought to be doing next. So one of the things that you'll notice this afternoon is that you've all got an iPad in your hands. Shortly, I'll ask Dan from Concise Media to come and give you a little bit of a rundown as to what that machine will do for you. But part of the reason we're giving you the iPads for use today is because it really points the direction for Cordium. We're a technology-led compliance consultancy. Much of our technology has been, we have already a well-developed technology solutions, much of which will be deployed in the UK in the coming years, and this coming year. We already have quite a number of our clients who are using our technology applications in the UK, and a very significant number in the United States. So that focus on technology meant that we thought we'd try and do something a little bit different and use technology for the purposes of this event as well. So without further ado, I'll introduce you to Dan, and then after Dan's finished, John Wilson will take the stage. John Wilson is the Director of Projects for Cordium in London, and John will then lead the next session. So thank you for now, and over to Dan.
Good afternoon, everybody. Hello again for everyone here this morning. I'm just going to run through the iPad very quickly. So hopefully you've all logged in by this point. Please make yourself known if you're having any trouble with your email address, and we can add you to the system. And to take you through the modules we have on your app. So first of all, we have the agenda. Next, we have the speaker biographies. And the next tab along, we have the presentation. And on this presentation, you can follow what's on the main projection. You can also make notes on the presentation if you tap on the screen. And you can also go into history mode, so you can take notes on previous slides. All of these notes you take will be saved in your notes gallery and then emailed out to your inbox post-event. You can also then take notes in the notes gallery itself, which is the next tab along. So here, all notes you've taken are saved in here, and you can take any notes that are not on slides as well. We then have our resources tab. So here you have all the content for your meeting, and presentations will be added to this throughout the day as well. We then have an email me form on the next page where you can select all the content you would like emailed to your inbox post-event. Next tab along, we have the interact button. And in here we have voting and ask a question. So we'll just do a quick polling question. Very good, just a quick practice. The question is, do you still think you can keep the iPads? I'm afraid to disappoint again, the answer is still no. And then we have Ask Question, which is in Interact also. So here you can send your questions through to presenter iPads. So all the presenters have their iPads up here, and all your questions will come through on there. Any questions that aren't answered in a live environment, don't worry, it's all captured on the server, so they'll be able to be answered post-event, hopefully. And then finally, you have your feedback form. So after you've completed this, if you just press the submit button, make sure all your information is captured. And now I'll hand over to John. Thank you.
Thank you. So in this afternoon session, what we'll be doing is focusing on an AIFMD and also on the compliance and technology solutions. But before we get into the panel, I just wanted to sort of look ahead really in terms of the afternoon session on UK regulatory issues and just introduce some comments and some thoughts really on how I see the UK regulatory agenda shaping up, and then that will lead into the AIFMD. And I'd like to get your contributions into that because we can use these iPads straight away in order to get some feedback on some questions that we have, which Philip will then incorporate into his panel session at the end of the day. So I'd like to approach this subject by looking just under a year ago when the FCA was still operating, and the FCA and the PRA were still both 6 weeks away from opening their doors. What was the FCA saying at that stage it would be like, and then has it followed through in terms of its thematic and enforcement agenda? And then what was it saying towards the end of last year around the type of asset management industry that it would like to see? So first of all, what I want to do is open up with a poll question, and the first poll question should come up on the screen in a moment, is about your opinions of the FCA. So in your opinion, has the creation of the FCA improved how alternative asset managers are regulated in the UK? Is it yes, worse, or no difference? Okay, that's settling down as if to say that there generally isn't a significant difference in how you're feeling the environment of the FCA. But as I say, we'll pick up on these points later on in the panel session. But I'll just go into now then some thoughts on what the FCA was saying a year ago. So fundamental to the new regulator's strategy was a recognition that rules-based and principles-based regulation had failed, and something more fundamental, more deep-rooted, was required to improve the public's perception of financial services. There was a presumption that uncontrolled markets were not delivering what consumers expected or indeed wanted, and there were no longer answers. In the words, sorry, I'll just move on to there. In the words of the FCA wanted to make markets work, provide consumers with a fair deal, and a language that generally epitomised some wider frustrations with financial services. The FCA said that firms should see meeting the fair and reasonable consumer expectations as their responsibility in the first instance and not the regulators. So the conduct of firms was central to the FCA. And this focus on consumer protection included wholesale conduct, not just retail conduct. Consumers need to be protected against activities which exploit differences in expertise and market power, the FCA said. And they wouldn't accept that some categories of relationship in which it shouldn't be interested in, just because of the sophistication of the parties involved. Now, along with all of this cultural talk, the FCA also wanted to show some elements of its aggressive side and talked in terms of more assertive and interventionist acting for the wider range of clients. And those tough statements appear to reinforce the claim the FCA would be on the consumer or the client's side. So then turn to the next poll question, which I know there's going to be a section on enforcement this afternoon, so it'd be interesting to get your thoughts here. The next poll question is really to try to get your gauge on how enforcement action by the FCA is affecting you. Do you consider that the thematic and enforcement policies, that's credible deterrence, that the FCA has pursued are relevant to the alternative management sector? that's coming out as a quite strong yes, and I think that's possibly reflecting the some of the issues that they've been dealing with. In fact, just turning back to the slides now, in terms of supervisory themes, only 2 of 13 thematic reviews listed on the FCA's website had some element of direct implications for investment managers. They related to outsourcing in the asset management industry and the recently published Transition Management Review. Both of those reviews identified failures of managing conflicts of interest, poor governance, insufficient independent oversight, and in different ways they picked up on this element of asymmetries of information, different levels of information between the client, the asset manager, and the service provider. When the FCA has actually talked about asset management more recently in documentation, they actually picked up in a document called Regulation Roundup that unregulated collective investment schemes and the changes to the rules there was an important issue. Well, it was, or it is rather, but it really only probably existed, formalised existing rules that were there, perhaps in the language of the FCA today, had not been applied by the industry properly. In terms of actual enforcement records, we keep a track of enforcement cases, which we discuss with clients on a regular basis. And since spring last year, there have been very few actual cases brought against asset management space, in the asset management space. But I think why that sort of high level is in terms of relevance is because of the issues the FCA are picking up on: AML, anti-bribery, mis-selling of suitability, financial promotion, transaction reporting, and of course, market abuse. Now, in terms of their more forward-looking agenda, the FCA used its annual management conference last October to set out the vision of shaping the future in asset management. Martin Wheatley's the chief executive's keynote speech, calling on the asset management industry to provide greater transparency, better management of conflicts of interest, and finally to address the main a perennial conflict of interest around bundled research and corporate services, an issue that I know has been around really since regulation has existed. Wheatley's speech was followed by a further speech by Clive Adamson, Director of FCA Supervision, who expanded on his expectations of the FCA has for asset management. And some of the things he said, and I'm going to quote from him directly: "When things go significantly wrong in a firm, it is not because it hasn't complied with a narrow set of regulatory rules, but because there is a fundamental flaw in the business model, in the culture of the business practices." Quote again: "Ensuring your firm operates to the highest standards is a cultural question, not a control or process challenge." And he said the FCA will adopt a supervision strategy for the sector which focused on your role as trusted agents, where asset managers do not let conflicts of interest interfere with the best possible outcome for clients. And then at the end of last year, Martin Wheatley, one of his last speeches in 2013, looked ahead and set a challenge of cultural transition in 2014. Now, we're starting to see that in terms of the use of dealing commissions consultation paper, which was announced by Wheatley in October last year. And also, I noticed just a few weeks ago, Market Watch was released, which published throw into the mix again best execution. And it provided a reminder of firms around basic rules, establishing an order execution policy, monitoring it, fixing it when it's wrong, and applying it to OTC derivatives too. And I'd sense that as with dealing commission, the FCA's work must be identifying some poorer understanding of the rule requirements, perhaps confused interpretations of those requirements, and is not seeing that firms are managing these conflicts at the heart of what they do. So bearing in mind that cultural agenda, I'd just start to pick up then on the third poll question, which again we'll fall into the discussion later on this afternoon, which is around how this agenda should impact alternative managers. Given the FCA's current focus on culture, which of the following potential conflicts of interest do you consider the FCA should be prioritising for alternative managers? Corporate access and use of dealing, execution and transaction cost analysis, charging of costs to the funds, investment strategy and its consistency with marketing, valuation, or something else? If you'd like to just poll there, please. Okay, so interesting, it's coming out there with costs, and it certainly looks like we're hitting some of the range of issues there. Okay, so that'll be picked up on again later. Can I just go back to the slides? Okay, now, in fact, these were the items which are a subset of those we just polled on, which we were considering as may well be relevant to investment management firms. And as I said, I expect the panel will start to discuss these later. Now, at this point, I'm starting to go into hedge fund and alternative management issues, and so I wanted to just sort of move on to the AIFMD panel itself. But just some concluding comments to carry through to this afternoon. Normally, regulatory priorities are a list of actions that firms must do, with timelines and key dates, responsibilities, and people to hold accountable for. But I think the challenge the FCA is setting us is not a list, but a way of doing business, or if you think you've already reached that benchmark, how you will demonstrate that. Is the role of trusted agent acting on behalf of and in the interest of the investors embedded in your firm from top to bottom? Now, at this point, I'd like to ask the AIFMD panellists to join the stage. Okay, in terms of panellists here, we've got. If we go from that side of things, we've got Adam de.Domenico from now Cordium, Malta, as of today. Kevin Tomlin from Royal Bank of Scotland, Corporate Trustees Department. Jonathan Mott, who's a regulatory transactions lead at Cordium, who's dealing with all of the applications and processing with the FCA. Lucy Millar from Hermes, Hermes Fund Services, a legal director at Hermes. Simon Thomas from MacFarlanes, and Neil Robson from Schulte, Roth and Zabel. Now, the process here is that we're going to pose questions into the audience so that you can lead us into the topics and then ask the different panellists to respond and comment within that area. And as always, we're happy to take questions through onto the iPad if I get to the stage of actually getting on the screen. Someone might be able to just sort out the iPad for me as to get the questions coming through on there. That would be helpful. So the first poll question, please, is in terms of preparing for AIFMD, which issue has primarily driven your determination of who the AIF and the AIFM are? Is it tax, regulation, location, remuneration, the investor's interests, or something else? Now, poll that. Okay, so that suggests that it's all regulatory driver and other issues are not taken into account. Neil, could you comment on that response and what you're seeing as the issues around the determination of the AIF and the AIFM?
Yeah, I mean, that doesn't really surprise me, and I imagine it doesn't surprise many people in this room, frankly, given that we've had several years now of the AIFMD being developed and the whole concept, the spectre looming over us all of much, much more intense regulation of AIFMs, managers managing these alternative investment funds. Now, what we've seen at Schulte's over the last few years is that some of our managers have been structuring themselves in such a way so that they can try and minimise or at least sort of deflect some of the impact of the regulation of the AIFMD on their business. Now, as an absolute starting point, and apologies for going back to basics, I'm sure most of you know the detail as much as anybody else does, but you have to start with the concept of, do you even have an AIF? And it may be a scenario, of course, that if you're predominantly offering managed accounts and funds of one, you may not have an AIF even to begin with, because an alternative investment fund, an AIF, is defined in the directive as a collective investment undertaking or investment compartments thereof, which raise money from a number of investors raise money from a number of investors, which invest that money for a specific investment purpose or under a specific strategy for the benefit of those investors, and which isn't a UCITS. Now, it has to be a collective investment undertaking, and their collective is key. So if you've only got one investor in the fund, hence this fund of one, as I was mentioning, then it may well not be an AIF, which would mean it falls outside the FM directive. Now, guidance which has come through from ESMA has been quite clear on this, that actually if you do have a fund of one, you have to be absolutely clear that that one investor is not itself a commingled vehicle. So you can't have a feeder fund, you can't have a nominee vehicle, which is the sole investor. Assuming that's the case, and you do have one single true investor, then what you could do is amend the articles of the fund or its constitutional documents so that you can only ever have at any one point a single investor. That would mean it's not an AIF and it falls outside the AIFM directive. Now, there are some scenarios where that may be enormously beneficial. For example, if you're an AIFM, your regulatory capital requirements, whether or not you're a small AIFM or a full scope AIFM, turns on your AUM in AIFs under management. So in terms of structuring, for some clients of ours, that's been a fairly important issue. But in terms of regulation of AIFMs, obviously the overriding factor is, are you even an AIFM? Because where you do have a multi-manager structure within your group, so let's take sort of the core classic example of you've got a Cayman manager which is appointed by the fund, so obviously for these purposes I'm assuming it is an AIF, and that Cayman manager then delegates portfolio management and or risk management to, say, your UK investment manager. Now, a whole raft of issues blow up here because you are the AIFM if you are appointed by or on behalf of the fund, by the AIF, to appoint portfolio management and or risk management. If you're appointed to do both, and you delegate both of them to a third party or indeed to your UK manager, then you are then determined to be a letterbox entity, which means you're effectively transparent for the purposes of the AIFMD, which means that you look through to the delegate, and that delegate, in most cases, would actually be defined as the AIFM. Now, if you're trying to structure yourselves out of the AIFM directive, scenario again with the Cayman fund or another offshore fund, it's not EU, so the only EU locus really is the fact that you're sat here in London doing the management. Now, if you're only doing portfolio management, so you've only got that delegated to you from offshore manager, then you may not be the AIFM, which means that actually you might not need to put your VOP into the FCA, which the vast majority of you are probably in the process of doing at the moment. Now, but that turns specifically on the point that you have to have a sufficiently robust AIFM offshore, and in an awful lot of cases that's not going to be possible. To have an offshore AIFM, you need to have that offshore entity being appointed by or on behalf of the fund to do portfolio management, risk management, and then it's delegating some element of those functions to you guys in the UK. Now, when I say some element of those functions, you can't delegate all of it. As I say, that would mean you're a letterbox entity and you'd have to be then seen as a transparent look-through. But if you're doing the risk management offshore and you've got oversight of the portfolio management being conducted in the UK, and you've got the ability to instruct your delegate, and you've got sort of reporting lines from that delegate, then it's starting to look much more likely that you would be deemed an offshore AIFM. Non-EU AIFM, non-EU fund, you only even come into scope of the AIFM directive if you're marketing in the EU. So for a lot of clients, that may be a really major, significant factor in terms of structuring. Going back to the point we just saw on the screen, that impact of regulation is a driving factor. Now, there's all sorts of other sort of permutations and issues there, but what we have started to see is that Malta, for example, the Maltese MFSA is allowing a much sort of reduced, shall we say, element of management offshore. It's onshore in the EU, of course, but offshore as far as UK people are concerned. So if you're doing risk management in Malta with 2 or 3 people, and you've got an element of oversight and supervision over the portfolio manager, you may be able to put a Maltese AIFM into your structure, which would mean that the UK entity, again, remains just a MiFID firm. I say just, I mean, it's still heavily regulated, of course, but it's not as heavily regulated as being a UK AIFM, which means you don't then come under all of the other issues that I'm sure the rest of the panel will be talking about in terms of the impact of regulation on your firm as an AIFM. Now, it's quite interesting because we've been seeing for many, many months now, with the uncertainty as regards the remuneration structure of UK AIFMs, whether or not we would have people trying to structure their AIFMs offshore so that they could stay outside the remuneration rules. As it happens, that's kind of evaporated in many senses in the way that the FCA has structured remuneration rules under the proportionality principle in such a way that if you're sub-threshold, which is pretty high, very high threshold to get over, if you're under that, most of the remuneration rules you should be able to switch off. So at the end of the day, that main concern that last year when we were sat here was probably one of the big issues, the big unknown, that's blown away now. So in terms of remuneration, that's gone. It may or may not be a factor for Malta or for Luxembourg or other jurisdictions. Key issue there being that if you're the delegate of an AIFM, which is within the EU, you're contractually obliged under the ESMA guidelines to comply with equivalent remuneration provisions as the AIFM itself would be. So there's still some issues there in terms of, are you going to be a delegate? Are you going to be actually the AIFM? Do you even have the scope to have an offshore AIFM? Or in fact, is that offshore entity a letterbox entity? And really, at the end of the day, you guys here in London, your investment manager is the AIFM and is then going to be subject to the AIFM directive.
And why do you think, I mean, when we had the planning call about this, I was almost surprised that this issue came up. I think it was Adam, you mentioned it in terms of the sort of uncertainty about exactly who was the AIFM. I mean, I expected we were very much talking about authorisation issues and day-to-day issues. So why do you think it is, and perhaps an open question, or you can respond, or Adam, that these issues are still out there? I mean, I met with a client the other day about co-investment vehicles and so on. Why are they still open?
Just on that point, and also kind of partly on what Lee said, from an AIF perspective, it's good that the poll here mentioned the highest one being the regulation, but I think the alternative holds true, whereby essentially a lot of managers are still debating whether the AIF is an AIF. And in their mind, if there's one investor, we all know, as Lee correctly stated, that you have to have the offering memorandum, you have to have the mandate, which clearly states you can only have one investor. But typically, a lot of questions are being raised, and there isn't a lot of clarity as far as when, at least the clients that we see, even from the legal side, as far as, yes, this is definitely an AIF, no, this isn't an AIF. And if you have a managed account scenario, for example, say Goldman Sachs managed account, is that an AIF, is it not? And I think people are avoiding the problem even at this point in time, even though, for example, in Malta, by the 1st of March, you need to apply with MFSA to become an AIFM or de minimis, and saying, no, that's a managed account, it's not within scope, ignore it. And I say, did you get anything in writing from your legal advisors? Like, no. And they have to go back. So notwithstanding that everybody knows that's, defining your AIF and defining who's the AIFM and your structure and everything, I still think there's a bit of uncertainty out there as far as what is an AIF and not.
Yeah, I'd agree. We're still seeing tensions in terms of some clients who have assumed that they have an AIF, but have then suddenly realised there's other options, like, for example, a holding company exempt from the AIFM directive. Certain joint ventures can be deemed exempt. So your point on co-investment, if you're both involved in, if two entities come together to make a single investment, they're both involved in the making of that investment and the management of that investment, it may well not be an AIF. And of course, there's also the family office exemption, so that if the money in the fund is from a defined group of family members, then it's outside the scope of the AIFM directive. So it is still an issue, and it is something we are still seeing on sort of a week-to-week basis, where clients are coming in saying, not sure we're even in scope here after all. Can we just go through X, Y, Z and figure out the detail?
Okay. One of the joys of the iPad is we get questions coming in from time to time, and they're on quite specific subjects, but they're not necessarily going to be covered later. But just throw this one in at the moment. Is a non-EU AIFM able to delegate marketing to an EU MiFID investment manager?
A non-EU AIFM to delegate marketing to a MiFID investment manager within the EU. That would be possible, yes, but the issue would be, for example, for the UK, the non-EU AIFM would have to file an Article 42 notification with the FCA to enable itself to be able to do the marketing, and then once it's done that, then, in fact, as part of that Article 42 notification, you can actually say which third parties you intend to do marketing for you within the UK, using the UK private placement rules. So it would be possible, yes.
Okay. And as soon as I think I've got the last question, another one comes in. An open-ended and closed-ended funds, are they treated differently under AIFMD?
Broadly, no.
No, basically the same. I think the only distinction might be around sort of private equity in terms of the style of the investment.
Indeed.
And there's also the sub-threshold issue as well,
Yeah.
too, on the limits.
Yes.
And also to add, as far as the structuring perspective, some things we've seen, at least in Malta, is the self-managed structure. So you have a self-managed fund, and now with AIFM, it would be a self-managed AIFM. That's typically a favourite when you have obviously smaller managers and managing their costs, or bigger managers setting up a new structure outside of the current world, and eventually opening it up into a manager and an AIF eventually once they hit 100 million and know thereof. But it seems to be taking a bit of momentum. It's very typical in the UCITS world, at least in Malta, where you have a self-managed UCITS, and again, it's because of cost together with managing for the manager not to become a UCITS manager, and now we're seeing it duplicated onto the AIFM perspective.
Okay, I'll move things on now because I'm sensing a number of questions that actually probably a lot of people have got their processes sort of sorted around this. So again, iPads, please, if you set those to interactive. Let's turn now to the FCA authorisation process and where you are and the lessons learned in that process. So the next poll question is regarding your FCA authorisation applications to be an AIFM. And I'd like to confirm whether or not your firm is currently authorised. That is as an AIFM. That's not meaning MiFID authorisation. As authorised as an AIFM. Your firm is currently dealing with questions from the FCA. Your firm is still to be assigned a case officer. Your firm has not yet submitted its application, or your firm will not be applying to be an AIFMD. If you could poll now, please. Well, that's interesting, actually. I was really expecting more to be in the process. So firms have still not yet submitted their applications, and I guess if we had one person authorised, we might have got up here and congratulated them on the stage. So, Jonathan.
If I said I had two already.
We didn't give you an iPad, though. Jonathan, could you give us some advice in terms of those firms that are looking to be authorised, clearly, or in terms of what the process is with the FCA and what issues they need to be looking out for?
Absolutely. If I could just talk about that as well. I think the FCA released some numbers yesterday. I think they've received 226 applications now. That's both variations and new applications, 119 in January, as we might expect. And that's a large number. I think we're still expecting about 800. I think that's what the market's saying, applications to go in. So there are, I think people are in the majority there. There are still a lot of applications to be seen, and one can only wonder what the effect of the Treasury's Christmas message had on this process, and whether had that not been put out, whether the picture would have been different. Yeah, I would just give a few, I suppose, bits from what we've seen through the authorisation process. We've been doing this on behalf of a number of clients. I suppose what people may want to know is it's taken between 8 and 10 weeks to be assigned a case officer. And we have seen it up to 16 weeks, but that was a complex case with a lot of apologies from the regulator also. During that time, though, the FCA is going through what they call their triage process and putting it widely within their departments. And when they do come back with their case officer, it also comes with a number of questions, typically anywhere between 10 and 15 we've seen. There are some themes within those questions as well. We're seeing a lot of questions around timescales. I suppose this is quite inevitable in that the form is kind of asking you to tell the FCA what you're going to look like in 5 months' time. And the FCA is almost being asked to take a leap of faith and trust firms. And that's not really a comfortable position the regulator likes to be in. So clearly they're looking to understand your plans, understand how you seek to meet all the things that you've said within your business plan and the variation permission form. Particularly on that, I think there's, I suppose, three key themes we're seeing, and that's investor disclosure. Clearly we need to make a lot of changes to the prior disclosure through this, I'm sure. Neil and Simon have been kept very busy updating, offering documents and schedules and the like. Also the depository agreements. I know the FCA came out and said it's not an incomplete application if you haven't either mentioned a depository or given a signed agreement. But if you haven't, they really want to know what you've done, what work you're doing, what due diligence you've done on your depository, and really a timeline of when you expect to sign that contract. They're also asking about the onboarding process as well with the depository, so I think that's an important aspect to pick up. The other area we've seen is they've asked around valuation agreements. I think that's particularly pertinent for anyone who's looking to delegate their valuation to an external valuer. And the FCA have been very clear that they want all this information a month before a firm's kind of requested authorisation day. And I think that's quite helpful that they had that box to say kind of when you want to be authorised, because I know certainly a number of our clients want to make the full use of the transitional period. Other information they've been asking for is valuation policies more generally. We've seen that asked on a number of occasions, and I think the message is that just be prepared to supply the FCA with anything that you've mentioned throughout your business plan and also your variation and permission. As we've said, it takes 8 to 10 weeks, and that's what we've seen, and we haven't seen that big rump of January application coming through. But you've got that 8 to 10 weeks to shore up any policies that you've started to draft and get in place, finalising risk policies or valuation policies, or even your compliance manual, and getting them ready for that point. The other, I suppose, more evidence piece they're asking for, if you're looking to cover your PII requirement through insurance rather than own funds, be prepared to give them the contract and some statement that it's AIFMD compliant, as they're asking to see those contracts and some notification that it does meet the requirements, as they're quite specific. And also capital adequacy. We weren't expecting this, as you've all, most of them are variation of emissions and you've been regulated for some time, but they are asking you to demonstrate how you can meet the new regulations or some new capital requirements. I'll talk a little bit more about that in a minute. Other areas of particular interest from the regulator, and we're seeing this more in the general application process, not just for AIFMD, is and particularly pertinent, I think, for CPMI firms who want the additional MiFID activities, that you demonstrate why you need them. As we know, under the AIFMD, if you're going to add other activities, you have to demonstrate you have discretion involved in there. So they are looking for executed or draft mandates within that, or if you can't, then a really solid business case that plays out within your financial projections to demonstrate that you need that. Just coming on to a point that we were discussing about who is the AIFM. I think, interestingly, albeit you've got your name of the firm on the variation permission, the FCA are still asking you that question in that Cayman piece. I think because they see the agreements, they see it between the Cayman manager, they kind of expect the Cayman manager to do it. I think we all know that that's not quite how it's going to work and won't fit the letterbox test, but at least they can tick that they've checked that test. One surprising element actually was we've seen not as many questions as we might have expected around risk management. Now, I don't know if that's, our clients have been really fixated on risk management and making sure they get this right, and I think probably the attention to detail in that, certainly that area, has meant there's been a really good job and really well explained throughout the business plans, which might be the reason for that. That said, they have asked for a bit of information around due diligence, some of the ongoing monitoring procedures that you've got in place, and also your stress and back testing. But we found if you send in the risk policy, that's probably a good way of fending off those type of questions. One area, further area that we haven't had questions in, but I think it's worth raising here, is the schedule of AIFs. Now, I don't know if people have filled that or come to terms with that form yet, but just we've had a number of firms that have asked us to do a review, business plan, variation permission, great, and then we tell them about the schedule of AIFs. It's a horrible form. I think it asks for 60 fields per AIF on information like AUM, NAV, information on leverage, both on commitment and gross methods, and also a lot of information about your service providers who you expect to use. And just when you've completed that, it also asks you to demonstrate where your disclosures are, so all the Fund 2.3, or 12 of them for each one, either where they are in your offering documentation now or where they will be in the timeline for them. So if you haven't looked at that form and you're going to authorise in the next few months, I would I'd certainly recommend having a look at that soon. If you've been to any of our presentations on AIFMD before, our message remains the same. The business plan is really the most important part of the application that you make. It's probably a good idea to, if you haven't done so already, read through the variation permission, get an understanding of the questions that the FCA are going to ask and try and answer them throughout the business plan. Many of the questions that the FCA have asked show that perhaps they've read some of the business plan, but perhaps not all of it, so you can just refer to the business plan or even just repeat what you've said, and that normally answers a lot of those questions. And I suppose if you've got anything more interesting within your model, I suppose if you're a UK AIFM who manages non-EEA AIFs, and you're not proposing to market in the EU and have decided not to have a depository, just make the message clear as to why you're not and what controls you've got in place to ensure that that's not going to be tripped. And again, for those who are still thinking about the application process, whether you're going to do it, how you're going to structure, if you're still going to change, there's been some useful classifications, or clarifications rather, that the FCA have put out more recently. I think the first is the funds under management definition, and this is really just for the capital piece, and that's for the larger funds who have over 250 million, and for any assets over that, you have to hold 2 basis points. The FCA have signalled that they're going to consult on this approach. Not helpful yet, but they have also said they're going to put out a waiver, so you can have a consent of modification, which is almost an accelerated waiver process that will allow you to calculate derivatives on a market value basis rather than having to convert these to the underlying positions, which might be helpful for some firms. It's interesting they're asking you to modify a waiver of the rule that doesn't apply to you yet, but that seems to be the way they've done it.
They have actually approved. I know one person here today has had that modification by consent.
Yeah, it seems to be a very, very quick process, so it's not a difficult thing to do. The other thing that's been clarified more recently, again pertinent for those CPMI firms, those with seeking additional MiFID activities, the European Commission seems to have been taking a different approach to the UK and suggesting that MiFID passports do not apply under or do not exist, even under AIFMD, which was going to cause some issue for those firms wishing to passport their MiFID activities into Europe. This seems to be clarified more recently, and I think MiFID II will seek to change that and make some amendments to Article 33. That said, MiFID II is still a way away down the line, although member states are saying they're going to change it, and certainly the European Commission will be suggesting that member states do say yes or approve any notifications that come through. So again, relatively helpful. We've talked a bit about remuneration, but it's probably worthwhile just tipping our hat to those. Again, on a Friday afternoon, helpful as always. The latest policy statement came out about remuneration, so I think we're now clear that those payout process rules kind of come in at 1 billion for a leverage fund, or 5 billion for unleveraged with a 5-year lock-in. That said, the FCA have been very clear that these are not strict thresholds, and you need to think of a number of factors, and there's some quite helpful guidance if you haven't had a look about what to think about in that process.
John, a question came in on the iPad, which is really around, is the FCA making any distinction around whether or not it's an application for the first time to be an AIFM or an existing MiFID firm going through the VOP? Is there a difference in the process and the way in which they're treating those applications?
It doesn't seem to be a difference in the way they're treating. I mean, if you're applying for the first time and it's a new entity, you have to go through the whole application process, including the investment management supplement and then also the variation permission form. So you end up having to do a lot of cross-referencing, and you will get the application questions as you ever would around capitalisation or work, though we're seeing that everywhere, and also legal status discussion. But really, there doesn't seem to be any difference. They seem to be working to very similar timelines. They have to have this 3 months under AIFMD for a complete application. So at the moment, we're not seeing a huge difference other than the questions.
Now, a scary thought, perhaps, is thinking about the amount of people that hadn't submitted their applications. I mean, there could be a temptation for some firms to take this to the wire and put those applications in very close to 22nd of July. What is the position, I mean, maybe it's an open question, what is the position regarding if you put your application in, but there's some procedural problem? There's not an issue with the quality of management, it's just a procedural problem with the application process, because the FCA can kick it back. Does that mean that technically they would actually ask the firm to close down, to suspend its activities?
I don't think I would ask them to close down. I suspect you're going to have problem marketing if you're going to be widely marketing around Europe. You can't exactly point to your regulation as an AIFM. As to why then, I don't know what's going to happen. I suspect everyone's going to rush around and get it done as quickly as possible.
Yeah. And as accurately as possible.
Perhaps I could John. I mean, I was NatWest Trustees acts as depository for some 40 would-be AIFMs, and connected with that is about 300 funds. And our experience is actually the same as was shown on the board. So about 50% of our clients have not applied for their variation of permission yet. And just to take up your point, yes, we are worried in case something, like you said, goes wrong. But what I can't see the FCA doing to an AIFM is saying, well, in that case, you must close down the fund if it's an existing fund. I can't see that happening at all. I can see them saying you're in breach of the rules, but you must put that right. So that's what I would expect to happen. But one point just to comment on in relation to who are they prioritising, they told the depositories that they were prioritising the depositories, because it's pretty obvious that you couldn't be an AIFM without actually having a depository. So they better work through the depository variation of permission application forms that have gone in first before they deal with the would-be AIFMs. Well, they're obviously not doing that very quickly, because I don't think any of the depositories, or the existing ones, for the alternatives business have yet received approval for their variation of permission. So we're still waiting, and ours went in before Christmas. And there isn't much information about when we might have that approved. But we're hoping it will be soon. What we're actually doing to try and encourage our clients to sort of get on with the process is, firstly, we've sent them some information that will enable them to do their due diligence on us. And we've found that has helped the process enormously, to the point where the majority of the clients don't necessarily wish to come and see us and investigate us, but they're happy with that due diligence document. And the other thing we've done is, of course, drafted the depository agreement and operating memorandum that goes with it, and we're seeking comments on that. I don't think any of those have been finalised yet, but there are a lot of them It's sort of sitting on our shelves, and between our lawyers and AIFM lawyers.
Okay, we've got questions, lots of questions coming in. One again specific around the application, and I don't know if we can only give a Cordium view of the average, but what's the average number of pages of a business plan that you've seen? I don't know, what's the Cordium view of an average?
I suppose depending on the complexity of the business, we're seeing between 15 and 25 pages, I think, for a business. But then, you know, what typeface is that? And as long as you're answering every question within the business plan with a way of how, I suppose outlining exactly how you're seeking to meet those requirements, as in the form that you should feel comfortable. It's your opportunity to tell the story about the firm, especially if you're an existing firm that they haven't seen. You want to tell the story. You want to tell them why they should believe in the firm and know it's a going concern.
Okay, I'll move on to another poll question now, which is our third, which is just moving perspective a little bit to an investor's perspective. And I'd like you to comment on which term best describes how you think investors feel about AIFMD. Do investors view it as a positive? They're worried about the increased costs. They're not interested in AIFMD. It's just starting to appear in their due diligence, or something else. So they were the thoughts I thought. But if you could vote on there, please. 108, 111. Yeah, I kind of, looks like it's waving out. I kind of thought that we might get that kind of response around not being interested. I think the increased costs one could be something that's specific, because it is something. It's the one specific thing that we've actually put up on the board there. Lucy, from Hermes' perspective, what has AIFMD ever done for Hermes?
Well, this time last year it gave me a massive headache. We decided as a house that we wanted to early adopt for commercial reasons, mostly to get the marketing passport. So we took the view this time last year that we would start to put our applications together. We went through a big scoping exercise, identifying our AIFs and our would-be AIFMs, and came out with the fact that we'd have to get three of our MiFID regulated entities regulated as AIFMs, and one of them was actually a brand new application as well. So we got our applications in two just before the 22nd of July, one just after the 22nd of July last year. I've got two back, so I have now two fully authorised AIFMs, and one we're still getting questions on. So from a manager perspective, it's been a challenge. It's been a costly challenge. I was talking with Simon earlier about clients not wanting to pay, wanting to pay all the fees that are associated with all of this, because it takes a lot of time and a lot of effort, and it's a very detailed process, and you've got to do it properly. Otherwise, you get stuck with the FSA for months and months and months on lots and lots of questions. But I think from an investor point of view, with my investor hat on rather than my manager hat on, the feedback that I've been getting from our investors is, actually it's quite interesting to see what the poll said. Cost is definitely something that they've really been concerned about. We've obviously gone through a big process, due diligence process, to appoint various depositories to our AIFs. There's obviously a cost attached to that. But I think as we have gone through the process with our various depositories, we've seen pricing policies start to settle down. I think there was a lot of initial real concern that there was going to be significant increase in cost. And we haven't seen that come through quite so much. So I think that has been helpful. I think one of the other pieces that certainly we've been sort of grappling with towards the end of last year and still are all the reporting requirements and the costs that go with finding a reporting solution. Now, obviously, again, from an investor perspective, there's concern about how much of that's going to be charged to the fund and how much they're going to have to pick up on that. But gradually, I think it is starting to settle down. I think this time last year we were all really troubled by the lack of clarity, the lack of certainty coming out from both ESMA and the FCA as to what all these rules meant and quite frankly, how much it was going to cost. I think it has started to settle down quite a lot now. I don't think it has been as bad as we thought it was going to be. But I still think it's too early to fully see the benefits of AIFMD, certainly as an investor. Interesting to see people saying, well, investors don't really care. I think they do. I think a lot of investors would still like to invest through a single investor fund if they can. rather than into a multi-investor fund, so that they don't have to incur the additional AIFMD costs. But I think that they will slowly start to see some of the benefits that come from AIFMD. I mean, in particular, certainly Hermes as a house, one thing we did was go through a extremely rigorous exercise to review all of our risk management policies. We had most of them in place already, but it was an extremely good exercise to look at them all together, put various umbrella policies around them, make sure that they were really robust and really fit for purpose and really complied with all the prescriptive elements of the directive. I think it also encouraged us to look at our internal reporting processes, how our boards were operating, are the right risk committees reporting into the right boards? Do the directors have the right transparency? And ultimately, will that help to see problems early, so that if there is a problem with the fund or something that's going, could have a big impact for an investor, will that additional transparency get spotted earlier? And I do hope that will be a benefit from the directive, but obviously it's going to be too early to see that.
Have investors picked up on that in terms of any due diligence that they do, in terms of asking, you mentioned risk management arrangements, sort of ask more to say, well, what are you setting as the minimum standard risk management ranges? Can you tell us more about that under AIFMD?
So I still think that from an investor perspective, when they're doing due diligence, AIFMD is still sort of seen to be a bit of a tick box exercise. Are you an AIFM, yes, or are you not? But I think as part of the ongoing awareness and understanding of what it means to be an AIFM, we are starting to see those sorts of questions. So when I actually sat down with some of our investors, last week to take some soundings before coming here, they said, "Oh, when we already do it," and I said, "Well, do you realise that this is the approach and what has to be done by AIFMs when they're during their application process?" We had a good debate about it, and I think people just need to get beyond, AIFMD, it's a nightmare. I mean, yes, it's a nightmare, but but I hope it hasn't been as much of a nightmare as we thought it was going to be.
A question came in on the iPad, which is, a comment really more actually than the question, which is around that, some press that saying 60% of managers are not really interested in AIFMD as a strategic plan until 2015. I think 2015, this point where there's talk of the opening up, passports being up to non-EU AIFMs. I mean, is in a sense the directive, the branding of AIFMD just too confused at the moment for it to give anything of substance for investors to rely on?
I think so. I think everybody's still too much in the thick of it, trying to comply with it. I mean, Jonathan talking about the detail of the actual application process. I mean, it's ridiculous. The form is ridiculous, and we had to do 3 of them. So I think everybody's kind of bogged down in the detail now at the moment because there's such a lot of it. But hopefully, yes, through time, 2015, people will start to see the benefits. And I think what's been interesting is we've all, certainly from a retail fund perspective, lived quite happily with UCITS for a while. I think AIFMD has sort of plugged the alternative fund gap there, but actually it's gone a little bit further. Now we'll see UCITS go a little bit further, and so. Broadly from an investor perspective, there is greater peace of mind there. But it's just going to take a bit longer for, I think, investors to feel comfortable.
One thing I'm quite intrigued by is the fact that obviously UCITS took several iterations to become to a workable form, where you had a passport for both manager and the fund that was functional. And we're starting to see suggestions from some of our clients who were thinking about setting up an EU fund and with an EU AIFM so they could get the passport. But there's all sorts of chatter going on about the fact that Italy still doesn't want you selling non-Italian funds in Italy. Their barriers are still there. So are you seeing that actually the EU passport is working? Because that's quite intriguing for us.
So yes, we are. I mean, I think initially actually trying to obtain the passport, even once one was authorised and have it recognised by other regulators, was a challenge. For example, the Central Bank of Ireland and the FCA couldn't agree on what the form should look like or what it would say. So even though we were authorised, we couldn't do the marketing because it wasn't. So there's still quite a lot of ongoing typical AIFMD type practical barriers because all of the process is new and the wheel is being invented from scratch. But yes, we are getting there slowly. But I think those countries who always had natural barriers to entry, they are still there,
still
and
in
it's
place.
it's going to take a little bit longer.
Because obviously it's only if the passport works for EU AIFs and EU AIFMs that it might even be considered by the Commission to be extended for non-EU AIFs and non-EU AIFMs. So given as, it's not that far away now, 2015 is next year, I think those wrinkles are going to need to be ironed out relatively rapidly if it's going to be extended in 2015.
Adam, I just wonder if you've got a view from Malta on the appetite for sort of marketing of alternative funds in Europe.
One thing to add, I think, on a similar note, but on the inverse, is that places like Germany and France, at least from what I hear, are actually looking not to accept PPMs. So in that case, then you need to be an AIFM compliant manager. Otherwise, you're not going to get into those respective markets. Whether they will or not, obviously, is yet to be seen. But obviously, people are rushing to become, the first manager or one of the first few managers to have a marketing edge. AUM is very hard to attract, and hence they think if they can check another box or not check that box, then they might be better off. But it's interesting to see where this whole marketing, passporting is going to go, and whether it's going to be as easy as people think, or whether it's going to have a similar usage aspect, whereby, notwithstanding they're supposed to be harmonized across Europe, it might not be. Every jurisdiction might have its own tweaks here and there, but we'll see.
Okay, I mean, one of the areas that actually the investors are supposed to take more comfort in is depository, and that's the subject of our next poll question, which is around your experience in appointing depositories. So, which phrase best describes how you would describe your experience in appointing a depository? And I guess maybe we're not all appointed yet, but our first choice of depository has met all our requirements. We've had to meet many providers, but have found what we need. We're still to agree who will provide depository service. It's being like the blind, leading the blind. We do not need to appoint a depository or none of those, please. So if we could just get your views there. Okay, and I guess the 33% might reflect that we've got a lot of people who are perhaps depository light with non-EU AIFMs, but equally quite a good split there really between, yes, the depositories deliver the services and also it's still in process. Unfortunately, not many sort of saying that it was a clueless process. So, Kevin, I mean, in terms of the market for depository services, how's that developed for those firms that are still really looking to finalise that depository appointment?
Well, I'm actually surprised that there aren't more firms that are still to consider who their depository should be. I suppose in the sense that the market has opened up a bit. There are new players to the traditional market, and there are actually all the other players that are coming in to operate in the private equity and property market. So there are definitely more players. I certainly know that because I sit on the Depositories and Trustees Association body, and we have lots of potential new members for that. So it's a growing industry, not necessarily of our own accord, but it does grow. I think the other thing to bear in mind is that it just simply depends on the nature of the funds that the would-be AIFM has, and whether their existing depository can cope with that, or whether, in fact, within a group, they have different funds, I mean, alternatives, but also, from what we've seen, investment trusts as well, which is obviously, a very new vehicle in the sense of having to have a depository, which creates sort of beauty parades, which an awful lot of depositories have been part of, and consideration of repricing and so on. So market's bigger, definitely. The pie is bigger. The choice is greater for AIFMs. So I think for a large number of the funds that we're responsible for and the AIFMs, the reason that they will just appoint us without any hesitation is because they already run sizable UCITS businesses, and we already currently undertake a very, very similar role for UCITS, and you plug AIFMD requirements on. Basically, it's a little bit more complicated than that, but when it comes to depositories, we can do that, and it makes sense. I mean, if the prices make sense to the client, the AIFM. So that's why I think a lot will stick with their existing. depository if they can. But there's definitely a lot of movement there, and you find that some depositories have decided they won't touch various parts of the market. Some have said that they're not interested in the PE business whatsoever, which has enabled actually some of the smaller depository vehicles to develop. Some have said not interested in all the problems that go with the alternatives market and hedge funds and so on, because that's all too much grief and difficult to handle. So some won't touch that. Some, like us, have said we will do things in stages. We've extended our provision from UCITS to non-UCITS retail funds, some of which are regarded as alternatives, and also investment trusts. And we're looking at whether we should extend the service to private equity and hedge funds and so on as time goes on. So even though we recognise that the first round is now, and we do believe that the depository market will continue to be a sort of healthy and vibrant market with plenty of competition.
I was going to say, I acted on a launch of one of the first AIFMD compliant hedge funds, which launched 1st of January. And sorting out the depository line I thought was going to be the easiest thing. It turned out to be an absolute nightmare. The client didn't have an administrator that had a subsidiary or a group company that could act as a depository, so we had to scramble around and find various parties to do various pieces. And so we rocked up to the PBs thinking that they would fulfill part of that function. Some wouldn't tell you whether they were going to or not. Some say they were going to do it but hadn't quite figured it out. Some pointed you in the way of a group company that's going to be the depository-like entity. And then the one that actually the PB is concerned changed their mind a week before launch. It proved to be incredibly difficult just to get some sort of consensus as to who was doing what, filling all the gaps, and then we found out that actually none of the depositories were going to do the custody of non-custody assets. So we had to find another party to do that. So we ended up with about 4 agreements, and as Lucy pointed out earlier, clients aren't desperate to pay for that. It has proved surprisingly difficult.
Another area that's been difficult, and something audits picked up on, is real estate funds, because I think there was perhaps the assumption that they can be private equity style, so they'll fit into the private equity model, but of course they don't. And I wonder if you've got some thoughts there on just how difficult it's going to be in terms of providing depository services to those funds as opposed to private equity.
So for our real estate funds, the answer is difficult. I mean, we created a lot of depositories for a range of our different in-scope funds. And I think the one that we're still struggling the most with is one of our real estate funds. It had quite an unusual trust structure, which we had to completely restructure just before AIFMD came in July last year, just so that we could take advantage of the transitional arrangements. And the current trustee isn't wild about being a depository, but there aren't that many, as Kevin was saying, there aren't that many depositories who want to undertake depository services for real estate. So it's a challenge, because obviously the fewer there are, then less competitive on pricing.
If I could do my advert here, we do act for a lot of the authorised property funds, so probably the lion's share of the market, and traditionally other of the sort of big 6 depositories that have been undertaking UCITS business, there are probably 3 or 4 of them haven't wanted to actually engage in property, and I can understand why. It's difficult. I mean, it's not easily susceptible to industrialised depository provision. So you have to set up all sorts of different systems and procedures as depository to cope with property, which we happen to have done and did from day one when they were introduced. So that's fine for us. We do have an ability to do it, but we don't actually see any of the existing large firms willing to enter that space now. There are the new depositories who say they're going to do property and private equity, but and I'm good luck to them. But I've not seen any evidence that they are well equipped to do it yet. It's not, there isn't any evidence, I just haven't seen it. I know a lot of those new type of depositories, I think, are more interested in private equity, and they're private equity administrators, really, rather than being sort of property professionals, let's say.
Okay. And Kevin, Jonathan, when he was talking about the FCA process, picked up on the FCA themselves are asking about the onboarding of the depository and the time that it might take. And given Simon's comments there about the difficulties with actually different parties promising, to do A and B and then not fulfilling it or not being clear, what are you advising sort of firms in sort of saying, the onboarding process and how long that's going to take? Because that's going to be a key factor in determining when you're operational.
Well, we're sort of saying, expect it to be 3 months. Generally speaking, it was a very, very general message. My one of our concerns at the moment is that actually most of our clients wish to be onboarded on the 22nd of July. Some of them we're encouraging to stagger the onboarding process. I mean, for their, partly for their benefit, certainly for ours. There's a lot that actually has to be done. I mean, onboarding is, I don't see it as a single hit overnight. Onboarding involves the laborious work that goes into agreeing the depository agreement. I mean, that's part of the onboarding, and that needs to take place months before one can become an AIFM. And the slight problem I think that some firms will have there is that if they haven't stipulated to the FCA when they want to become an AIFM, they may find that all of a sudden they do become one, and then they have to comply with the rules, and the depository has to kick in into operation immediately. And we don't really want that to happen. So we are actually encouraging dialogue with the FCA, and what we're doing actually is spending a lot of time with our own clients and would-be clients to ensure that there's a proper, what we would call, onboarding plan.
There is, of course, one other aspect on this, which a couple of the PBs have been suggesting to clients to, in their VOPs, to say you're not marketing, therefore you don't need a depository. So leave that bit blank. And then you get regulated, and then you put in the name of your depository, and 2 weeks later you've got approval. I don't see it as the best plan, no. But it is definitely mooted.
Okay, and that would be in terms of a non. Would that be all AIFMs, or would there be non-EU AIFMs?
Non-EU.
Non-EU.
Yeah, I mean, we're seeing that model would probably only really work for an established manager who's putting in a VOP. If you're a new manager, you're a startup. Yep. You can't really justify in your FC application that you're not going to be marketing your fund. You're not going to be fundraising in Europe. It's not going to wash with the FCA. It really won't. Okay, we've got 2 more areas that we're going to cover before we move on. And I just want to move on now in terms of, we've asked questions, another poll question. So we've asked questions around your applications. I now want to ask a question around your status in terms of readiness for AIFMD. So we have the next poll question up on the screen. And I have calculated them, so I do think it's right. There are 100 FCA working days until firms must be compliant with AIFMD. In terms of readiness, do you consider yourselves ready? Ready except for the Annex 4 reporting requirements. We know what to do and by when, so that means when you have a detailed plan. We're still finalising, we need to finalise our delivery plans, so you're still working on those delivery plans, or we're not implementing AIFMD. So this is about your confidence for 22nd of July. Right, so I think a lot of people there are really, the majority of people are still in that sort of delivery and planning stage, with a large quarter actually not implementing AIFMD within the room. Simon, I mean, that's really about the whole overall sort of assessment of where the firm is at. And in terms of getting the AIF actually ready for AIFMD, I understand there's lots of sort of documentation, requirements around just preparing the AIF itself as opposed to just the manager.
Yeah, I mean, you can, at its heart, the directive is a client protection, customer protection directive. It's trying to look after the interests of investors, and whether or not it does is another question. And you look at that and actually think, well, okay, what do I need to do to protect investors? Well, it's about marketing, mainly it's about marketing, disclosure to marketing, and transparency. So looking around at marketing as a whole, And I'm familiar with all the conversations about reverse solicitation and whether you can actually passively raise money by reverse solicitation. I have my doubts. Why employ all these marketing people if actually you're saying, actually, we're not really marketing, it's reverse solicitation. What that means for most of our clients is the getting ready for AIFMD has effectively meant looking at their offering documents, looking at their relationship with their service providers, ensuring that's ready, because most of the other stuff is actually internal operational procedures, which they tended to be doing already. So when clients come to us, they're saying, we have put our VOP in, we will want to update our offering documents. I can say, well, okay, you've got until July to do that. Mostly it's transition. But just bear in mind a number of things about marketing. We talk about reverse solicitation. Second point is that about 80% of hedge fund money comes from 2 jurisdictions in Europe, leaving aside Switzerland. So it's the UK and the Netherlands, pretty much where all of the money comes from. The remainder of the jurisdictions, I think Sweden may be the next biggest, and Sweden's quite difficult. But actually, France, where everyone talks about reverse solicitation, it's always been reverse solicitation. Italy, nobody quite knows what's happening in Italy, but let's assume it's reverse solicitation again. Spain, reverse solicitation. Germany is the other big jurisdiction, but when you think it's a big jurisdiction, actually only about 3% of hedge fund money comes from Germany. It's quite a surprise. So a lot of our clients are saying, what do we do about Germany? We'll say, well, okay, well, we'll deal with that issue later. So if you're updating your offering documents, first of all, you've got to be thinking about how am I going to make that offer compliant in the UK, and how am I going to make that offer compliant in the Netherlands. Both those jurisdictions very much, friendly and at home to offerings. So you look at Article 23, and there's a long list of things you need to disclose to investors. Pre-investment. There's no actually prescribed way of actually, the directive doesn't say it needs to be in your offering document. It also actually doesn't say it needs to be in your articles, so you don't necessarily have to change your articles to this. What the directive says is you need to mark it in accordance with the constitution of the fund. The FCA changed that from in accordance to in line with. Not quite sure what the difference is. It's probably a plain English thing. So it's in line with the constitution of the fund, which actually means that as long as you're not inconsistent with the articles, then you're fine to put out, as you normally do, the terms of the fund, the description of the investment manager, and the like. You also have to think about actually, do I need to update the offering document itself? Or is there another way of doing it? Because there's no prescribed way of disclosing to investors. We've done European wrappers for clients who have decided actually they don't really want to mess with the standard form. They've had it for years. And so we attach a schedule at the back which has all the European disclosure that is required. We'll actually go through the offering document. Probably about 90%, maybe not quite as high, 80% of the disclosure is already there. So there aren't that many changes to make. Some of them are a bit awkward, but you can fit it into a wrapper fairly easily. It's probably not that long a wrapper. The other issue which we've wrestled with a number of clients is when we're coming to actually disclosing making the changes is, do we disclose it in the round? In other words, if you read the whole page, do you get the sense that you've made the necessary disclosure? Or do we have to specifically deal with each point by point? And we saw an early adopter of the directive actually try and deal with this issue by having a schedule at the back, which cross-referred to Article 23 at the back of it, and the page reference, so it's saying we disclose use of leverage, page 34, something like that, at the back. I think that's probably going a little bit far, but the way we've fallen down as a firm is generally we're quite prescriptive in that we do try and almost line for line, say exactly what is in the directive. So if you ever go to a regulator, you can point exactly to it is, and rather than them have rejected because you've disclosed it in the round. One of the other points we've said, as we've dealt with, is that a lot of the disclosure you can't actually make in the offering document because it changes too regularly. So then the question is, well, how do you go about disclosing it? It needs to be disclosed before investment. Material changes need to be updated, so that's a periodic disclosure. You can change your offering document, and I would say you should be changing your offering document probably yearly. I would say that, I suppose, but I think you need to change it a lot more than you have. The other point is kind of, well, how do you actually go about making these disclosures? The best way we think we've found is secure websites, whereby clients are putting leverage calculations, NAVs, behind a firewall, disclosing it, releasing it to potential investors and investors. that meets your disclosure requirement. So it doesn't necessarily have to be in the offering document. Some of the things which still cause a lot of problems and how you go about disclosing matters. One is side letters. I don't think we've actually really kind of like come up with a really satisfactory way of dealing with this. You have to ensure that there is fair treatment for all investors. You also have to ensure that if there is any preferential treatment for investors, you disclose it, and you also disclose the type of investor who gets that preferential treatment. So how do you go about doing that? It's quite difficult. The best way I think we've dealt with so far is, again, behind the firewall, come up with a list of terms that people may or may not get. Also, but we don't identify investors by names. We say large US pension funds that invest 200 million have been able to get the following terms. That just prompts a number of questions from investors. It's quite difficult. In private equity, before the AIFMD, what we used to do was just come up with an amalgamated side letter and send it around everyone so everyone could see what they get. It's a negotiation. So it may be that we'll actually just have to get used to this way of dealing with it. It is going to be in writing on the website maybe, so everyone points to it. But the Cayman Island lawyers will say, well, you have to treat each investor in a class fairly, so what do you expect? And the FCA have already made one kind of a ham-fisted attempt at regulating side letters probably, what, just about 8 years ago, maybe a bit longer. Yeah. And pretty much everyone ignored it. And so the directive is that other way of capturing that. One of the other points which touches on the FCA's review of the whole structure when it comes to VOP is when we were doing one, we had the FCA absolutely pore over the corporate structure. They looked at the corporate governance at the fund level, they looked at the corporate governance at the Cayman manager level, and then they looked at the corporate governance at the regulated level. And they started looking at cross-directorships, and they started identifying directors that had more than 30 directorships. Started asking questions as, can they really supervise that? You have a principal who's a member of the LLP, he is the guy behind the fund. He's also on the board of the manager, and he's also on the board of the fund. How does that work? So we took him off. That's how that will work. The COO, for example, though, he remained on the board of the fund, and the FCA started talking about conflicts. And it was quite a difficult conversation. One, it's possible that whoever it was had gone on a course and he learned about conflicts, so therefore he's got to ask questions about conflicts. And so one of the questions he actually said was, the fund doesn't appear to have been out for tender. It's appointed the manager without any competitive process. So, well, yeah. How we dealt with it in the end, we struck upon the magic wording, which you wouldn't think if you haven't done your VOP yet, is we effectively parroted back the conflict wording in the directive to say we're aware of all our conflicts and we'll treat everything, and that was accepted. But it was a real struggle, particularly the point about we'd hired a fantastic director, one director you'd really want on your board, really good at it, and they're saying, he's got over 30 directorships, I can't believe he'll spend the time looking after this fund. And the other point was about the COO remaining on the board of the fund. They were saying that's a conflict with the manager, and we were saying, well, actually, the investors want him on the board of the fund. Is that really a conflict? It was quite a surprise. So it took more time than it really warranted. The final point I want to touch on is on relationship with the service providers. We talked about depositories earlier. Your relationship with your administrator will change because now the AIFM is responsible for valuation. That means you're going to have to change your IMA because it needs a valuation section in there. That means you're going to change your administration agreement because they're no longer responsible for valuation. What used to happen is you used to sign the administration agreement saying the administrator, I agree, I am responsible for valuation. And then over the years, particularly as the large banks took over administrators, they started saying, we're not actually valuing the fund. We're actually the calculation agent. We just add up the numbers provided to us by the manager or Bloomberg or somebody. And it was actually unclear as to who actually valued the fund, and quite a lot of the administrators would go back to the board and say, please confirm the valuation of the fund for this week. Now it's quite clear the manager is responsible for valuation. Virtually all of our clients have decided that they're not going to bother with an external valuer.
Likewise.
They just don't see any benefit to it. They're still responsible for valuation of the fund. It adds an extra service provider, for no real obvious reason. We have some clients who are desperate to do it and have got their administrator to agree they're actually acting as external valuer. And there has been lots of argument over their liability. I'm quite happy to do that for the clients, but actually the benefit really to the investors seems limited as such. What that means for arrangement, for the agreement is we'll have a tripartite agreement now, probably, between the fund, the manager and the administrator agreeing who's responsible for valuation, what the administrator does in calculation agent, producing the NAV, and the board will still have its duties under Cayman Island law. It will still have to sign off on this and present it to investors. That has, again, proved surprisingly difficult to agree. There's a lack of consensus amongst the administrators. But that's coming into place now. Investment management agreements are fairly easy to change, but there are quite a few changes to them. One thing mainly being the termination right is that now the manager has the obligation to terminate the relationship with the fund if the service providers aren't doing what they were going to do.
Okay, in the last few moments, I'm going to skip our last poll question because it's just really want to move to Adam, really, because I mean we've been very much focusing on the UK and the points being made about sort of the FCA sort of interference and so on. And sometimes people perceive that as an attractive reason to change destination. So I just wonder, in the moments available, if you could sort of sell Malta to us as a destination without mentioning the weather, please.
Well, it's sunny today, so.
No, we're going to skip the poll. If we just like to talk about Malta.
Sure. So, well, opening line was going to be it's sunny and it's very tax efficient. But it's sunny here, but actually it's pretty nice weather. For those of you that don't know, Malta is south of Sicily. It's in the Mediterranean, EU member states. We have a very firm but yet friendly regulator, which is not very same in other jurisdictions from what I hear. Literally, it's a phone call away to meet the regulator, to discuss, to meet the person who's going to be working on your application or whatever problem you may have. We've heard from many clients that that's very welcoming. The asset management business in Malta has been around for, I'd say, the last 10 years. And in the recent past, Malta has become a jurisdiction of choice for funds and fund managers. We have all the professionals you need with, again, 10 years plus experience, be it the Big Four, second-tier audit firms, legal providers. So both funds and fund managers are in good hands. As far as the topic at hand, from an AIFM perspective, Malta transposed the AIFM directive into Maltese law in July of last year. You can currently have the similar approach as it has here. You can have a MiFID firm, de minimis firm, obviously threshold and all that. You can opt in to become a full AIFM. Obviously as of July, and all depends on the type of structures that we discussed before, whether you have an AIF or not. A couple of points from Malta particularly, we mentioned them before. One of them is remuneration. Obviously, similar to the FCA, MFSA had the same approach, so MFSA will not look through to a sub-investment manager. So if you have a typical situation where you have the AIFM in Malta and a delegate to the sub-investment manager in the UK or wherever, the MFSA will not look through, and hence the remuneration from an AIFM perspective will stay within the AIFM. And if you have a typical MiFID firm in the UK, you'll adopt the same processes you have today. That is obviously quite interesting for the 1.5 billion plus managers, because obviously you can see how you manage your remuneration. Depository, we mentioned that as well. Obviously, typical structures will have your fund in a non-EU, so you can apply, MSA allows for the depository light. And then obviously you have an AIF in Malta or anywhere in the EU, you'll need a full depository anywhere in the EU, obviously Malta included, until 2017, after which either the rules will change or hopefully others will set up. Just a couple of experiences of a couple of clients that I'm working on. One is a MiFID firm looking to become fully AIFM compliant, and they're doing that predominantly from a marketing perspective because they're very small from an AUM perspective. In that case, whereas on a MiFID structure, similar structures as mentioned before, whether you have a Cayman or Malta, I think it's somewhat similar, but obviously Malta is a regulated environment. But you'll have on a MiFID firm, you'll have a minimum of a board and an investment committee. And depending on the structure, the size, and AUM essentially that you're on, you might need staff or not. Now with the AIFM, obviously, as we know, you need to have various structures, including looking at your valuation, looking at your remuneration. In both cases, you might need a committee for either. Again, proportionality applies, so you might be able to get out of it. But definitely, you'll need again, as was judged before, either risk management or portfolio management, or a bit of both. In this particular case, that actually it's a long-short equity, so it's pretty straightforward, and they're keeping both services in-house, and hence it's definitely a full AIFM. Others would pretty much use the risk management option and leave the risk management in the AIFM in Malta, also outsourcing it to a certain extent, but you cannot outsource it in its outright, so you actually second an employee to the AIFM, and that seems to be in line with the AIFM requirements, particularly MFSA. Another case is a new manager who came into Malta looking to set up a self-managed AIFM. We encouraged them to actually set up, because they had quite a decent AUM pipeline. We said, you know, you're going to be an AIFM in no time, so set up an AIFM rather than a self-managed AIFM, separate from your AIF. Apply for it from a de minimis perspective initially, so you can get a fast track to get your license. Once you have that, you can go up to 100 million pretty quickly, and you can start trading away, getting your performance, and immediately will apply for the full AIFM license without any major issues. And timing is obviously on our side in that case. And equally, they'll be managing the fee income with their respective costs from a risk-based approach. Ultimately, I think Malta is definitely a good option from a selling perspective, because everybody's familiar with the Cayman structures, but is it regulated? Is it the AIFM or not? When it comes into Malta, obviously Malta is looking to become the AIFM, and it's not that difficult to make it the AIFM. Obviously, it very depends on what strategies you have. Can you really do risk management out of the AIFM, which is not near you? Does the CIO need the risk manager near him? But telecommunications and all is pretty easier today. And even now Cordium, we can offer hosting from a Malta perspective, so you won't really need to leave the UK too often, but definitely on a few times, and hopefully that's welcome, given it is actually a nice place to be.
Okay, we've had a lot of questions coming through on the iPad, and I thank you for those, and I apologise that we've not been able to get to all of them, but there were a lot of them were quite specific questions, and really, possibly if you want to talk to the individual consultants outside, we'd be happy to sort of deal with those outside the forum. We've actually covered AIFMD for the last three forums we've held. Very light touch, and I think at the first session we hit it quite hard because we thought it was impending last year, and I think we've hit it quite hard again. And you've given us ideas for next year, because we've had one question from the audience as to whether or not by the time of the first review in July 2015, sanity will return and the EU will perform a massive U-turn. I'm not sure it will, but I think it's an interesting debate about which is to come around opening up Europe to non-EU funds. But that's for next year. I'd like to thank our panels and everyone else for their contributions today. Thanks so much.